Provision for doubtful debt is a financial accounting concept that allows businesses to account for the possibility of bad debts in their accounts. This provision is created to account for the likelihood that some of the accounts receivable will not be collected from customers due to insolvency, bankruptcy, or other reasons. To illustrate the concept of provision for doubtful debts, let's assume that a business has $100,000 in accounts receivable outstanding, and it estimates that 5% of these accounts are likely to become uncollectible. Therefore, the business would need to create a provision of $5,000 for doubtful debts. The double entry system of accounting requires that each transaction has two entries, one on the debit side and one on the credit side. When a provision for doubtful debts is created, the following double entry accounting entry is made. Debit: provision for doubtful debts, an expense account on the income statement. Credit: allowance for doubtful debts, a contra asset account on the balance sheet. The provision for doubtful debts account is an expense account that reduces the net income of the business, whereas the allowance for doubtful debts is a contra asset account that offsets the accounts receivable account on the balance sheet. In subsequent accounting periods, if any of the accounts receivable become uncollectible, the business would reduce the allowance for doubtful debts account and record the bad debt expense as follows. Debit: bad debt expense, an expense account on the income statement. Credit: allowance for doubtful debts, a contra asset account on the balance sheet. Overall, the provision for doubtful debts concept ensures that businesses account for the possibility of bad debts in their financial statements, providing a more accurate representation of the financial position of the business.